All right, let's jump right in. Welcome to This Explainer, where we're tackling a major financial rite of passage that practically every young professional goes through, the first payslip shock. We're diving straight into Module 1 of the Finlit Zambia curriculum, zeroing in on income, budgeting, and goal setting to demystify exactly how your money works from the absolute second you earn it. Where did my K200 go? Man, if you have ever started a new job here in Zambia, you absolutely know this feeling. You land the position, you calculate your expected salary, you make all these big spending plans, and then payday finally arrives. The bank deposit hits your account, and it is noticeably less than you thought it would be. It's a very real shock that catches so many young Zambians off guard. Okay, let's dive into this. Today we're looking at 1. The first payslip shock. 2. Decoding Zambian statutory deductions. 3. The 50-30-20 budgeting rule. 4. Setting smart financial goals. And we'll wrap it all up with 5. A check your understanding quiz to lock these skills in. Part 1. The first payslip shock. To really wrap our heads around the math here, we're going to look at a super relatable case study to anchor our numbers today. Meet Grace Chibinga. She's 19 years old, and she just landed her very first proper job over in Lasaka. Her employment letter stated her salary crystal clear, 3,500 kwacha per month. Like any organized person, Grace meticulously planned out her K3,500 gross salary. She mentally allocated 1,200 for rent, 600 for food, 300 for transport, and left the remainder for her savings and a brand new pair of shoes she'd been eyeing since December. Sounds like a perfect plan, right? Well, then she received her actual payslip, and staring back at her was this bold number, K3,290. That's her actual net pay. And that visual discrepancy between her K3,500 expectation and her K3,290 reality meant the immediate breaking of her budget plan. She hadn't even spent a single kwacha yet, and she was already falling short. So what happened? That brings us to part 2, decoding Zambian statutory deductions. It's time to decode the necessary hurdle of mandatory taxes so we can figure out where Grace's missing money went. Let's break down the exact math step by step. Step 1 is Grace's gross income, the K3,500 she was offered. Step 2 is NAPSA, the National Pension Scheme Authority. By law, 5% of her gross is deducted, which is K175. Now, this isn't lost money. It funds her future retirement pension. Step 3 is NHIMA, the National Health Insurance Management Authority, which takes 1%, or K35, to ensure she has access to health care. And step 4 is PA, pay-as-you-earn, income tax. But look at this. For Grace, it's zero. For once, the taxman literally takes nothing. And here is exactly why that happens. After deducting her NAPSA contribution, Grace's taxable income drops to $3,325. Because that number falls well below the 2025 Zambia Revenue Authority tax-free threshold, which is $5,100 per month, the system protects her. She pays absolutely zero PAYE. Moving on to part 3, the 50-30-20 budgeting rule. Now that we know where the money went, how do you actually plan your spending? The absolute golden rule here is that you must always build this plan from your net income, never your gross. Now, what's really interesting about this slide is how the 50-30-20 rule perfectly balances your life. You allocate 50% to your needs. These are your non-negotiables like rent and food. Then, 30% goes to your wants, allowing for limited fun and entertainment. And finally, 20% is strictly for savings and debt repayment, ensuring you are always paying yourself first. Let's see how this practically works for Grace. We apply the 50-30-20 rule directly to her K3,290 net income. That gives her K1,645 for her needs, K987 for her wants, and realistically sets aside K658 for savings. Her old plan broke down because it relied on money she didn't even have. This new plan, it's totally resilient. Which leads us to part 4, setting smart financial goals. Look, simply allocating savings in a budget is essentially useless if you don't have a concrete, trackable target to aim for. Just look at the contrast between these two approaches. I want to save money this year is a vague wish. It's doomed to fail because it has zero parameters. A SMART goal, however, is specific, measurable, achievable, relevant, and time-bound. Writing it down like this changes everything. Look at how powerful this is. I will save K300 per month by cutting airtime from K200 to K80 because I want to pay my school fees. By December 31st, 2025, I will have K3600.
By adding exact methods, strict dates, and realistic kwacha amounts, you turn a hopeful intention into an achievable reality.
All right, part 5, check your understanding quiz. It's time to ramp up the energy a bit. Let's do a rapid-fire knowledge check to make absolutely sure you've locked in these essential skills. Let's go.
Question 1. Grace earns K3,500 gross. After her K175 NAPSA deduction, her taxable income is K3,325. How much payee income tax does she pay? I'll give you a brief second. Remember that K5,100 tax-free threshold rule we talked about? The answer is 0, not a single kwacha. Because her taxable income is below the K5,100 threshold, she pays absolutely nothing in PAE. This brilliantly reinforces how Zambia's progressive tax bans protect our entry-level earners. Question 2. Imagine you earn K4,700 per month net. Under the 50-30-20 rule, how much of that should go straight to your savings? Try doing the quick mental math for 20% of K4,700. It's K940. So the crucial point here is that you need to move this money out of your checking account and right into savings before you spend a single tungui on anything else. You've got to pay yourself first. Moving on to question 3. In what specific order are statutory deductions legally made from your salary here in Zambia? Try to recall the step-by-step unpacking of the payslip we did just a few moments ago. Here is the exact legal breakdown. First, you start with gross income. Then, NAPSA is deducted. Next, your PAE is calculated on that remainder. Then, NHIMA gets deducted. And remember, NHIMA does not reduce your taxable income. Finally, what's left is your net pay. Question 4. Which of these statements is a fully smart goal? Is it, I will save more money? Or is it a specific plan to cut airtime spending to hit a certain amount by a certain date? Identify the difference between a vague wish and a structured goal. It's definitely the specific plan. I will save K300 a month by cutting airtime. It works perfectly because it contains clear actions, precise kwacha amounts, and a strict deadline. It is totally measurable and achievable. And finally, question 5. Why should you always budget from your net income and never your gross salary? Well, because budgeting from your gross means you're consistently overspending before you even see the money. That money was never yours to begin with. Mastering that final take-home figure is the ultimate key to true financial control. So ask yourself, what could you actually achieve this year if you stopped budgeting invisible money and started building a rock-solid plan with what's actually in your bank account?